In this webinar, I will show you a compelling analysis that shows how and why cash value life insurance performs better than your usual stock market investment. The goal here is to place your standard investment and cash value life insurance policy side by side and to make this comparison apples to apples as much as it can be. To do that, we need to match all the moving parts, the same funding for the same period. The anchoring value that we can use for the fair comparison should be the internal rate of return of both investments. So first, let's determine the internal rate of return of life insurance policy. In other words, we need to determine the growth our client is going to earn from the cash value in the policy over their lifetime. First, let's use our Insight software to run a cash value life insurance policy for our 35-year-old male investor. Let's call him Mr. Miller. There are several options how we can structure our cash value life insurance policy so it can serve us to fulfill different goals. As you can see here, we can design it to maintain a minimal life insurance protection or death benefit, but to maximize retirement income or distributions later from the policy. Or we can just build it strictly for cash accumulation so that we have liquid asset available to us to use it in the future for any purpose. Or the focus can be protection and to build the largest possible death benefit for our beneficiaries to receive after we pass away. In our example, we'll structure the policy so that its main purpose is the cash accumulation for the retirement, and then later on, we want to also build strong death benefit for our heirs to inherit. We'll choose both Index Universal Life and Whole Life products. We'll fund this policy by paying premiums $25,000 annually in our working years to build a strong cash accumulation, and later in our retirement, we'll reduce our premiums to $7,000 annually to maintain the large death benefit protection as our legacy to our heirs. The great advantage of using Insight Intelligent Quoter or EIQ software is the ability to search among hundreds of life insurance products and to recommend the top 40 or 50 based on the requirements we just established. Now we sort through these and select the top 10 products. While our software is processing, we can choose the criteria based on which we'll compare these products. You may notice the Whole Life offer much stronger guaranteed cash accumulation and death benefit protection, but they're behind Index Universal Life products in non-guaranteed or current market values, meaning Whole Life products are designed for investors who are more risk-averse. Since our primary focus was on maximum cash accumulation for the retirement and also strong death benefit for our heirs to inherit that we'll plan to build later in our retirement, we go along those lines to choose all the criteria we based our comparison. This is how it looks like after we input our chosen life insurance policy numbers from the ledger to our life insurance values calculator. As shown before, you can see our investor plans to pay $25,000 every year into the policy for the next 30 years and then reduce his payments to $7,000 in retirement. You can see the age and the policy year columns. So for example, if you're healthy today, your mortality, based on mortality table stats, age, gender, and overall health, is around 85 for men and 87 for women. So if we run this out to, say, age 85, we can see the 6.07% internal rate of return on the net cash value at age 85, and that is policy year 51. Or, for example, in policy year 20, the insured age is 54 and the internal rate of return is 4.14%. The way it works in the cash value life insurance policy is when you see this 4.14% of internal rate of return in year 20, it means as if the client has been earning 4.14% the entire time, every single year for the past 20 years. And I'll prove it out to you. Let's check the numbers in our rate calculator. We take the annual payment of $25,000. The future value at that point was the number, this one, $786,746. That was over a 20-year time frame. And there you go, 4.14%. You'll notice someone setting aside $25,000 annually into any kind of investment. It doesn't have to be cash value life insurance. Earning 4.14% every year, never a losing year, never a down year, will accumulate this $786,000 in year 20. So again, the way life insurance policy works, as if the client has been earning the given internal rate of return percentage the entire time every year. However, if we examine the ledger from the top, it shows the negative internal rate of returns in the policy's beginning years because of the particular structure of the life insurance policies, which are so-called cost front-loaded. The fact is, in the early years, life insurance companies reserve a higher percentage of the cash value to protect themselves for something called the net amount of risk. The net amount of risk is a difference between the policy's total death benefit and the cash value that builds up in the policy. Therefore, that difference is the highest at the very beginning of the policy's life cycle, and so are the costs. Yet, this structure proves to be very efficient for the cash accumulation in the long run. In the later years, when the policy's death benefit and the cash value levels up, the net amount of risk gets reduced to very low, if not all the way to zero. Lower net amount of risk means lower overall charges. Less onerous charge structure means more cash accumulated, and quickly we get to this point of exponential compounding or the money snowball effect. The next step is to place the ordinary taxable investment and cash value life insurance policy side by side to paint a clearer picture. Let's do that. In our funding calculator, we're going to input the current age of 35, projecting the calculation to the age of 70. We'll pull in our life insurance number from the ledger we have created, both the permanent cash value life insurance and the 30-year term insurance, and you'll see why. So those are now stored in our funding calculator. We're showing the growth of our life insurance funds at 5.59% internal rate of return, represented by this number, $2.7 million in year 20. So let's document this. Let's grab some notes, and we're going to show right here $2.7 million. This is our cash value at age 70. We're using 5.59% internal rate of return that showed to be our average rate of return. Remember, the internal rate of return percentages were negative in the beginning years due to the front-loaded cost structure of our policy, but later it quickly picked up and reached up above 6% of internal rate of return. So combined, we got 5.59% as the average percentage of internal rate of return. Therefore, I'll copy this entire decimal number and paste it up here where it says annual investment rate. So we will use the same rate for our alternative investment fund. Again, we're comparing side by side two investment vehicles here. On one side, we have our cash value insurance, and on the other, your standard investment like stocks or mutual funds. To make this comparison apples to apples as much as it can be, we're matching all the moving part inputs. So same funding of $25,000 for 30 years and then reduced to $7,000 at age 65 for the remaining 6 years. Same annual investment rate of 5.59%, and the goal would be the same cash value of $2.7 million. So when I click on Alternate Account tab, you see it's as if you were to earn 5.59% each year of your investment life cycle without a down year to equal the same $2.7 million. See, you have to understand what kind of asset we are designing here. It earns almost 6% year in, year out. And not just that, but an investment that's safe, guaranteed, that's protected, where you have access to liquid cash, and in most cases, it's entirely tax-free. So what else is out there that will deliver all of these benefits in one package? What comes to my mind are maybe CDs or some sort of savings or money market accounts. But first of all, those are not tax-free. And also, those types of accounts are earning nowhere near 6% of return, especially not tax-free return. On the other hand, the life insurance proceeds and policy loans are tax-free, the growth in the policy is tax-deferred, and the withdrawals are tax-free up to the basis. Let's see what this would look like if this money were taxable like CDs, like saving accounts, and even a brokerage account with stocks and mutual funds. Let's look at 32% tax bracket. So what we immediately see after adding tax input is an increase in interest rate on alternative account to match our cash value life insurance. The internal rate of return now goes up to 8.23% because taxes do have to come into play. And what it means is that you would have to earn 8.23% every year, pay the tax on that to net the $2.7 million. You had that amount with your cash value life insurance without all this hustle. So not an easy challenge to accomplish the same result with your usual investment. But we're not done yet. Because this money went into life insurance policy, you also have a death benefit included in your investment. So beyond needing to earn 8.23% every single year in your alternative investment, we also need to compensate for death benefit. Well, besides life insurance, there is no other investment that offers death benefit. So what people do? Well, a lot of them buy term insurance. So let's pull in the term insurance cost in the equation, because that is a cost. We ran the 30-year term for our 35-year-old, and you can see right after inputting these $775 term insurance premiums, the interest rate on alternative account increased to 8.42% to match our cash value life insurance values. You heard the saying, buy term insurance and invest the difference as a better investment strategy than investing in cash value life insurance. You might have heard of Dave Ramsey, as he often recommends this. Let's use our calculation right here to prove this to be a myth. After they buy term insurance, where do most people invest the difference? Most of the time, it's invested in mutual funds or stocks. It could be an IRA, 401k, could be a brokerage account. And in those accounts, like mutual funds, like stocks, there is something called asset management fee. Now, we have seen management fees as high as 4%, 3%. I'm only going to use 1.5% management fee. Suppose you were to take this money, place it into alternative investment with management fee. Now, the internal rate of return of our alternative account has to be 10.07% to match our cash value life insurance values. What that means is that you would have to earn 10.07% in your alternative investment every single year. Every year to reach the value in the life insurance policy of $2.7 million of cash. Not an easy challenge, but we're not done yet. Keep in mind, we ran this to the age of 70 to show $3.7 million of death benefit. What happens with the investor in the alternative investment? Well, they have the term insurance coverage for 30 years, and after that, at their age of 65, the coverage goes to zero. Now, when they're 65, buying another term insurance or extending the existing one would cost our investor arm and a leg because of the ever-increasing cost of insurance as we age. But this cost is mitigated in our cash value life insurance due to its front-loaded cost structure. That's why we can afford death benefit coverage in our cash value life insurance for our entire lifetime. In conclusion, we have shown mathematically here that this was 5.59% rate of return every single year. What other investment out there earns consistent almost 6% year in, year out? And not just that, but that's safe, that we have a control over, where you have access to liquid cash that's protected from collections, lawsuits, and even bankruptcy, and in most cases, it's entirely tax-free. What else is out there that will deliver all of these benefits in one package? It's pretty powerful, and that's what you get if you invest in cash value life insurance policy. I love showing our funding calculator to our clients because it tells a compelling story. We want our clients to understand that the standalone benefits of owning cash value life insurance policy are just one portion of the story. But when you compare it with the usual stock market investment, the strength of cash value life insurance stands out even more. Yes, it's a unique investment tool with guaranteed rate of return. It offers downward protection in case you invest in Index Universal Life, or it pays dividends every year in the whole life policy. In addition to that, it provides lifetime death benefit protection. But it's so much more than that because it's a multi-layered tool with the privileged taxation status on one hand and the long-term cash accumulation cost structure on the other that is not case with the most other investment tools out there. So there you go. I hope this analysis made you consider adding cash value life insurance into your investment portfolio. Should you have any questions or maybe want to schedule a free consultation with our team here at Taxable Wealth, please do not hesitate to call or email us.